Thank you very much, Mr. Chairman, and welcome. Good to see you again. My first question, as you might guess, is about digital assets. You had testified yesterday in front of the House Financial Services Committee that one of the stronger arguments in support of a central bank digital currency was its potential to render stablecoins and virtual currencies unnecessary. But in March, you acknowledged that Bitcoin, Ethereum, and other virtual currencies are essentially a substitute for gold rather than the dollar. So I want to talk a little bit about the difference between the two. So it's pretty clear that Bitcoin, Ethereum, and other virtual currencies are investment commodities and not payment instruments. The SEC and CFTC have said as much in court cases and regulatory actions. So I think what you were trying to get at is one of the best arguments for a central bank digital currency is that stablecoins could be rendered unnecessary. But legally speaking, stablecoins and virtual currencies are not synonymous because stablecoins don't increase in value generally and are used as substitute payment instruments, whereas Bitcoin, Ethereum, and other virtual currencies are investment assets. There's research from Fidelity, Deutsche Bank, and Credit Suisse, among others, that call Bitcoin an emerging store of value. Goldman Sachs has also said the same about Ethereum. And so my question is, because stablecoins and a central bank digital currency are more synonymous with a dollar as an instrument of payment, and Bitcoin, Ethereum, and other virtual assets are more an investment commodity like gold, when you spoke to the Financial Services Committee in the House yesterday, did you mean that stablecoin would be unnecessary if we had a central bank digital currency?
You're right. But let me say, though, with cryptocurrencies, it's not that they didn't aspire to be a payment mechanism. It's that they've completely failed to become one, except for people who desire anonymity, of course, for whatever reason. So that's why I included them. But I would completely agree. Really, the question is stablecoins. And my point with stablecoins was that they're like money funds, they're like bank deposits, and they're growing incredibly fast, but without appropriate regulation. And if we're going to have something that looks just like a money market fund or a bank deposit or a narrow bank, and it's growing really fast, we really ought to have appropriate regulation, and today we don't.
And I would assume, thank you for that. I would assume that you would agree that some common definitions and kind of a clear legal framework would help us understand the opportunities associated and the risks associated with financial innovation.
Yes, I could certainly agree with that.
Thank you. Thanks so much. Now I want to turn to monetary policy, and I'd like to draw your attention to this chart. Federal Reserve and Bureau of Economic Analysis M2 data shows that deposits and close substitutes held by households have generally averaged 51% of GDP from 1952 to 2021. But then data from the end of quarter one of 2021 shows that households are sitting on deposits and close substitutes of approximately 79% of GDP today. So that's roughly 28% or trillions of dollars above the historic average. So going back to 1952, there's never been a higher percentage of household deposits to GDP. Monetary policy also has been highly accommodative over the last 16 months to the tune of 32% increase in the M2 money supply. So I haven't heard anybody talking about this hidden stimulus. And when households start to spend this cash, combined with the enormous liquidity already out there, it seems there's real potential for inflation to continue to overshoot. We've already seen it this week, as the core consumer price index number was nearly double what economists had predicted. So here's my question. is it really wise to continue to have accommodative policy when there's still trillions of household cash that will flow into the economy soon?
So this, I think the main factors driving this up are really that people have been sitting at home for a year and a half, not able to travel and go on vacation and spend money in restaurants and things like that, and also combine that with the major fiscal transfers that Congress made. So there's a lot of cash, as you know. There's a great deal of cash on household balance sheets, and that's what this is representing. Is it appropriate for us to continue accommodative policy? We think it is, but as you know, we're in the process of evaluating, when it'll be appropriate for us to taper, which is to say reduce our asset purchases. We're having a second meeting that'll address that topic directly in a couple of weeks. So, but for the time being, the other thing I'd point out is there's still a lot of unemployed people out there. And we think it's appropriate for monetary policy to remain accommodative and supportive of economic activity for now.
Thank you for your responses. Thank you, Mr. Chairman. I yield back.
Thank you, Senator. On behalf of Senator Brown, I'll recognize myself, and at the conclusion of my comments, I will yield to Senator Warnock.